Is inflation running hotter than what the government has been reporting? Has inflation been underreported for decades? Some are making this case. In today's video, we're going to test and examine this claim. Now, since 1985, official inflation, as reported by the Bureau of Labor Statistics, has been fairly steady, averaging roughly 2.8% per year. Now, outside of 2020 to 2022, we see this has been fairly stable growth for inflation and has been below average if we compare this to the last 100 years. But some believe this number isn't entirely accurate. Through talking with retirees and reading comments on some of our videos, there's a frequent belief that real inflation has been running much hotter than reported, anywhere from 7 to maybe as much as 15% per year. Now, this is obviously an alarming idea. If you're earning 5% on cash, but real inflation is 7%, but is being reported at 3%, you think you're outperforming inflation at a reasonable clip, when in reality you're actually lagging behind and losing purchasing power each and every year. Now, part of the reason this belief exists is because the Bureau of Labor Statistics has frequently adjusted the way that they measure inflation. In simplistic terms, the government measures inflation by taking a basket of goods and then tracking the price of those goods through time. Within this basket, everything from food to housing to energy costs are tracked. But in the early 80s, the housing cost variable received a big adjustment. Prior to this adjustment, CPI would specifically track housing via mortgages and direct home prices. Tracking just this variable leads to some sizable volatility, as you can see on the screen. The last 4 years have been a perfect example of this, as we've seen the convergence of higher interest rates and prices rising, leading to basically a doubling in the median mortgage payment over this short period of time. To adjust for this volatility, economists replace just housing costs with a term coined owner's equivalent rent. Over the last 4 years, renting has become significantly cheaper than buying a home in most real estate markets. Because of this, many will choose to rent rather than buy for a period of time, and economists believe this substitution should be factored in to the inflation numbers. Another example of a change we've seen in CPI is using substitutions for some goods. For instance, let's say in a basket of goods, the government tracks the price of, let's say, cucumbers. But because of terrible weather or a virus that has decimated the cucumber harvest this year, cucumbers have skyrocketed in price. Economists believe that very few people are so attached to buying cucumbers that if the prices of cucumbers tripled, they'd stop buying cucumbers and it would instead substitute, let's say, zucchinis as an example. Or rather than buying chicken, one might buy turkey. This replacement or substitution to a similar product or good would now be factored in. Now, these aren't the only two changes. You can look at the Bureau of Labor Statistics website and see a timeline of every change since the 1980s. And these changes are often cited as the reason inflation has been underreported, and there's no doubt truth to this claim. Housing costs over the last few years is a perfect example. Reported inflation would be much higher if the old way of measuring housing costs was used. But I think a strong argument can be made that most of these changes to the CPI formula have been fairly reasonable. Actual consumers will look at the options they have and they will substitute in reality. But nonetheless, there are those that claim the government has adjusted inflation for more nefarious reasons. Keep in mind there is an incentive to do this. When tax tables and income streams like Social Security are meant to adjust to inflation annually, if inflation is underreported, it means the government will collect more tax revenues and have to pay out far less to those programs like Social Security. A popular website that I've seen cited by those who believe inflation has been underreported is shadowstats.com. This is a paid newsletter that tracks inflation based on the 1980s calculation, before substitutions and the adjustments over the last 30 plus years were installed. And as you can see from the chart on the screen, if CPI was still measured the old way, it looks like inflation would be running consistently at 5 to maybe as much as 15% per year. Now, I'm not willing to pay the $180 per year this newsletter charges to see the exact data, but we can see from the chart that average inflation since the 1980s looks to be somewhere in the 7 to 9% range. Now, up to this point, maybe the data and reasons I've shown have been somewhat compelling. Maybe you've never thought about it, but now it does seem like inflation has been underreported to some extent. Well, before you jump to any conclusions, we can pretty simply test this theory, this idea that inflation has been running much hotter than reported. Keep in mind the incredible power of compounding here. It's easy to say that inflation has been running at 7% for decades, But keep in mind the difference that would actually mean in terms of compounding. Over 39 years of inflation, we're rising at 2.8%. Something that used to cost $1 in 1985 would now cost approximately $2.93. If inflation was at 7%, something that cost $1 would now cost $14. And if inflation was rising at 12% per year, something that cost $1 in 1985 would now cost a whopping $83. Put in this context, it's much harder to believe inflation has been underreported by as much as some claim. For instance, on the screen I have a basket of common goods one might purchase throughout these years. I have the 1985 price in column 1, and then the current prices of these goods in column 2. Then in columns 3 and 4, I have an estimate for what these would cost if inflation was running at 7 to 12% and affected these goods directly. Now, as you can see, the actual cost of these goods in 2024 is nowhere near the estimates of what actual inflation has been running at, or at least what some claim. And it's not even close. If we look at basic consumer goods, this narrative of inflation being underreported completely falls apart. But let's expand this to higher price items like college, cars, healthcare, and more. Yes, the cost of a home has risen substantially, but if home inflation was running at a 7% inflation rate, we'd see the median cost of a new home at nearly $1 million. Even when we look at categories like college and healthcare, which have both categorically seen higher inflation than normal CPI, we still see a 7% inflation claim fall apart. Again, keep in mind just how expensive compounding can be at even a 1 or 2% higher inflation target. Then compare the cost of a new car. In this example, I chose a 2-door Ford Bronco as an easy comparison. Could you imagine paying $170,000 for a new car? I can't either. That's because inflation hasn't been running as hot as some claim. When we look at this simple test, we can see that if inflation has been underreported, it's been by a small margin at most. This fear that the government has been massively screwing you over by underreporting inflation is simply just false. And here's the other thing it seems no one seems to mention when discussing inflation. Inflation measurements do not track the quality of goods. The main reason for this is that it would be incredibly difficult to track the quality of goods. But consider this, how much have cars improved since 1985? We now have smarter, safer, and more efficient vehicles than 40 years ago. In basic economic terms, you would expect something that is superior to cost more. This isn't factored at all into inflation. We no longer use leaded gas because it poisons the population. So gas has become higher quality. The median size of a new home in 1980 was around 1,750 square feet. The median size now is around 2,500 square feet. So we would expect to pay more for a bigger house, yet this isn't factored into inflation. So realize that there are counter arguments and cases to be made that inflation is sometimes overestimated in some ways because it doesn't track quality. The larger point is, don't believe the claims that inflation is being massively underreported. It doesn't stand up to the sniff test. Also keep in mind that CPI is meant to be a target for approximately 350 million Americans and not a direct target for the goods that you purchase. There are always going to be problems that you can find with broad estimates, and CPI is far from a perfect measure in general. But a lot of the changes the government has made to inflation measurements make sense on some level, or at least you can make an argument for it. So in today's video, we dispelled a common myth. Another common myth many investors believe is that the money that you keep in cash consistently just loses to inflation each and every year. As we show in this video right here, this too can be easily dispelled. In fact, cash has been an asset that has outpaced inflation if you invest your cash properly. Click here to learn more, and always remember, you don't need more money, you need a better plan. Thanks so much for watching today, and we'll see you in the next video.